So on the Fed and the inflation, I mean, there have been shifting narratives and quite significant shifts in narratives so far this year, and both from the Fed and from the market's assessment of what the Fed is trying to do. And I think where we are right now is the critical question is now actual data has to now show whether the Fed is correct and this is all temporary, or there are some persistent forces in play which are likely to remain with us for the next several months and start to shape actual policy. So actual data now is the key.
Yeah, and I was looking at your copy on this in your June report as well. And look, there can't be many of us out there that would begrudge anyone, I certainly wouldn't begrudge anyone having a higher minimum wage and getting up to $15 per hour. This is how you get America's median salaries to better levels, and you get consumption going as well. So even from a pure economic point, it's interesting. But you think this has the ability to have years of persistent inflation rather than just be transitory?
Definitely, Steve. We have done some work on some of the biggest employers who are not paying or are not yet paying $15 per hour. And if you chart out their journey over the next 2 to 3 years, and if they get to that level, you're looking at wage inflation of anywhere between 7% to 15%, depending on which employer we are looking at. So that's over a period of 3 years. And we're not talking about months here. The accountant view on this is that, it's just that 1.5% of the labor force which would be affected, but that is a very one-dimensional view because there are substitution effects. So we have to actually pay the people who are getting paid $15 now more to compensate for the extra skill. So this can pass through the whole stack, and this can have potential strong persistence, which cannot be counted in months, but it's actually a multi-year trend which can start to take hold.
Salman, I want to ask you about the importance of earnings season, because it can take steely nerves or a lot of optimism to be cutting short positions when you've got a market trading around a record going into earnings season. What do you make of the expectations and how high they're running at this point?
Hi, Karen. And on earnings, the revisions have been quite strong. Actually, the momentum going into the Q2 has been very, very solid. But there are important sectoral differences. Cyclicals are the ones which are seeing much of this earning positive revisions momentum going into Q2. So the important thing would be if cyclicals do deliver on those high expectations as this reopening and reflation starts to play up in actual data. Because as we know, over the last few weeks, there has been a lot going on underneath the index. So even though record highs at the index level, there's been a lot of rotation still in play. So having said that, the last few quarters, the momentum in earning revisions has been all in cyclicals. So the question would be now, firstly, for us to think about is whether that is delivered. And the second dimension we are watching very, very carefully is margins, because we know input prices have been quite strong, and we now need to see if those prices are being pushed forward into the chain or not, because that will have important implications for margin.